The Financial Meltdown of 2008, a case study by Ted Lewis. The financial sector is one of the infrastructure sectors identified as critical by the Department of Homeland Security. The department identified it as such in the 2003 Homeland Security Strategy document and later in the NIP, National Infrastructure Protection Plan. It consists of banks, brokers, and savings and loan companies, as well as Wall Street firms, the Federal Reserve System, and the electronic systems Fedwire, SWIFT, and others. The subprime mortgage collapse and ensuing financial system meltdown of 2008 was the most significant event in financial history to strike the U.S. financial sector since the Wall Street crash of 1929. The Dow slipped from an all-time high of 14,000 points to a low of 6,400 points within a span of 18 months. A correction in excess of 50%. In this module, we study the events leading up to the massive market correction and use the Amaral-Meyer Network model to simulate the crash of 2008. The Amaral-Meyer Network model shares many similarities with the actual financial system structure at the time of its collapse, but of course it is an approximation of reality. Nonetheless, this model contains many features quite like those found in the financial sector. Our analysis answers the question, what does it mean to be too big to fail? We show by simulation that financial system collapses are not a matter of big firms failing, but rather of firms being too connected. A connected firm is one with many business connections with other firms. We show that the size of a correction increases with the number of connections among firms. This raises a policy question. What rules might be applied to prevent major corrections and crashes in the financial sector? Amaral-Meyer network simulations suggest that limiting the connectivity of firms is better than protecting highly connected firms from failure. We show that periodic elimination of the most highly connected firms greatly reduces the size of financial system corrections by a factor of 5 to 10 times. That is, removal of the most highly connected firms is better than protecting them from failure. David Faber describes the origins, evolution, and consequences of the 2008 financial crisis in his book, And Then the Roof Caved In, published in 2009. It is clear from a careful reading of this case study that the highly interconnected system of lenders, intermediaries, Wall Street firms, and international buyers formed a very highly connected network. The nodes of this network are the players: savings and loan lenders, local and regional banks, Wall Street investment firms that bought, packaged, and resold mortgages, and finally the international brokers in Iceland, France, Russia, the UK, etc., that bought the packaged mortgages in the form of securities and credit default swaps. The links in this network were provided by business relationships established for the purposes of buying and selling mortgage-backed securities, MBS, collateralized debt obligations, CDO, and credit default swaps, CDS. This highly optimized network was much like an ecosystem consisting of predator and prey, fox and hound. Wall Street firms found innovative ways to package, repackage, and reprocess home mortgages so they could be sold to retirement funds, personal portfolios, and governments around the world. They identified niches in this ecosystem and filled them with products for all levels of risk and reward. A simplified version of the financial network that sprung up during the 1990s and 2000s is shown here. At the local level were the lenders. Companies like Wells Fargo Bank, Countrywide, Conesco, Bank of America, Greentree, Ameriquest, and New Century lent money to consumers at prevailing rates. Often these loans assumed ever-increasing collateral in property that was increasing in price due to the housing bubble that formed from about 2003 through 2007. As long as prices were rising and therefore equity was increasing, the risk of default on these loans was negligible. At the time, nobody considered the possibility of deflation. How could the banks lose when home equity was constantly going up? Lenders obtained more money to loan out by selling their loans to intermediaries. For a time, Fannie Mae and Freddie Mac stayed clear of these packages because of inadequate documentation of low down payment requirements. So Wall Street firms such as Morgan Stanley and Goldman Sachs stepped in. Later, Fannie and Freddie came back into the market and began buying these so-called subprime mortgages. The links in this illustration are not accurate, but are for illustration purposes only. A link, however, models the business relationship between firms. Lenders fed packaged mortgages to the intermediaries, and the intermediaries repackaged them for other firms higher up on the food chain. The lower-level firms provided a livelihood for the higher-level firms. Therefore, an ecosystem of predator-prey was established. At the next level up, Wall Street firms such as AIG, Lehman Brothers, Bear Stearns, and others bought and repackaged the mortgage-backed securities, MBS, for resale to even higher-level entities. But the Wall Street firms added an element of complexity, the CDO and CDS. These are derivatives, securities derived from other securities. This innovation made even more money for investors who believed there was nothing more secure than a mortgage-backed investment. After all, people have to have a place to live, and the ever-increasing equity in homes guaranteed a good return on the derivative. The crash of 2008 defied this logic. Essentially, CDO, CDS, and the synthetic CDO became worthless when the housing bubble burst. Finally, Wall Street peddled CDO, CDS, and synthetic CDO to international clients. Because of its stability, strong dollar, and decades of solid returns, derivatives from the U.S. were highly valued throughout the world. Flush with emerging economy cash, investors from Russia, China, Iceland, France, Norway, and other nations rushed to buy Wall Street's innovations. This was the state of the financial network as of 2007, the peak of the housing bubble. Innovation, global communication, low interest rates, and excess cash were fueling a global boom, which in turn fueled the purchase of trillions of dollars worth of derivatives. Then the roof caved in. How did this happen? Nearly all catastrophes start small and grow, like a snowball, gaining size and speed as it rolls down the side of a glacier. The meltdown of 2008 is no different. The collapse of the financial system started small and spread as the dominoes fell one by one, sweeping through the global network. Interestingly, the crash of 2008 followed the same rules of many other hazardous events, such as hurricanes, earthquakes, and terrorist attacks. The existence of stock market volatility, storms, earthquakes, and acts of terrorism is not surprising. However, their size tends to surprise us, especially when the consequences are huge. In other words, we ignore the small events and look for explanations for the big ones. What caused the meltdown? Subprime mortgages are simply non-standard loans that appeal to consumers looking to buy a house with little cash. Monthly payments are reduced by paying for interest only or temporarily reducing interest rates. In some cases, a low down payment or reverse equity mortgage is used to seduce the buyer. A reverse equity loan essentially borrows money against the owner's equity to pay for the loan. When housing prices are going up, or the owner expects to flip the house after a few years, a subprime loan makes sense. The owner will never pay off the 30-year loan, but the owner's down payment leverages an ever-growing equity in the house. What is there not to like about this investment strategy? From 1998 to 2000, consumers leveraged their houses to the max. Traditionally, buyers bought houses worth 2 to 3 times their annual income. By the end of the boom, some owners in California were leveraged 10 to 1, and the national average grew from 3 times income to 4.5 times. Furthermore, subprime mortgages traditionally account for 5% of all loans. During the period 2002 to 2006, subprimes grew to 20% of all loans. Subprime lending was the first step toward catastrophe. Lenders fund new loans by selling the old loans in the form of mortgage-backed securities, MBS. That is, a package of loans is turned into a security such as a bond and resold to investors of all sorts. Rating companies, such as Moody's, place bond ratings on these securities so investors can gauge their risk. Higher-risk bonds pay a higher rate of return. Lower-risk bonds pay a lower return. The rating companies assured investors of their risk, thus becoming complicit in the trade. Unfortunately, they failed to do their job, and many AAA-rated MBS were actually BBB, or junk bond securities. Thus, rating companies, seduced by the boom, became a contributing factor to the system's eventual collapse. Wall Street innovators were not only seduced by the lure of highly rated securities, they were also complicit in the crash. Innovations such as the CDO, or collateralized debt obligation securities, became a source of big profits. These derivatives were collateralized by the borrower, and they were debt obligated, because everyone expected the borrower to repay the loan. However, Wall Street did not anticipate the coming foreclosures caused by deflation of home values. Borrowers would soon walk away from their debt obligation, because who wants to pay back $500,000 on a house worth $250,000? CDO securities suddenly became junk, adding even more fuel to the growing fire. The innovators of Wall Street did not stop with CDO. They invented another business that hedged against defaults of CDO. The credit default swap security, CDS, was essentially an insurance policy against the unlikely default of the CDO. That is, one group of investors bet that borrowers would repay their loans, while another group of investors bet they would default on them. Either way, investors could win by placing bets on both sides, as Goldman Sachs reportedly did. This is how hedge funds work, when hedging works. The CDS market eventually crashed AIG. At the peak in 2006, AIG insured $2.7 trillion worth of CDO. That is, AIG bet heavily that borrowers would repay their loans. However, when the foreclosures began to snowball in 2007, AIG's bet fell through, and it could not pay up. By 2009, the U.S. government had invested over $180 billion in AIG to keep it afloat. This raises a question we address later. What would have happened had the federal government not rescued AIG? More innovation followed. The voracious demand for securities exceeded supply, so Wall Street invented the synthetic CDO. In simple terms, a synthetic CDO is a package containing CDS that have been turned into a bond. The bonds are rated by rating agencies so brokers can price them and investors can manage their risk. Unfortunately, this led to a false sense of security. Because rating agencies did a poor job of rating, the CDS hedge liability exploded as mortgage-backed securities deflated in value, and CDO payout also exploded. One can say that the derivative market blew up in the investors' faces. The synthetic CDO was an innovation gone too far. It contained nothing of value except perhaps promises to pay, which could not be honored. Regulatory policy may be as much to blame as the risk-taking of Wall Street. After all, the financial system was following policy established by Congress over a period of decades. Generally speaking, Congress reduced regulations over a period of decades, starting with the Employee Retirement Income Security Act, ERISA, of 1974, and the Community Reinvestment Act, CRA, of 1977. Mortgage-backed securities have been legal tender since ERISA became law in 1974. Among other things, this act established 401ks, 503cs, and the open trading platforms we are familiar with today. Rating agencies were established in accordance with ERISA to apprise the public of the risks associated with buying securities. ERISA established the legal basis for the inevitable crash. The CRA of 1977 broadened the scope of lending. Its intent was to motivate banks to make loans to a broader community of borrowers, including people with less collateral and less ability to make monthly payments. The CRA promoted the idea that home ownership was as American as apple pie, elevating home ownership to a right rather than a privilege. In a further step toward less restricted regulatory policy, the Depository Deregulatory and Monetary Control Act of 1980 eliminated interest rate caps on mortgages. It set the stage for subprime lending and greater risk-taking. Banks and investment houses could now leverage deposits even more, sometimes reaching loan-to-equity ratios as high as 30 times. In other words, for every $30 million of risk, banks held only $1 million of equity. Subprime mortgages were the exception rather than the rule until 1993, when the number of subprime loans began to soar. Within a few years, subprime loans rose from 5% to 20% of all loans. Typically, subprime loans expand home ownership, but in hindsight, it allowed people to buy homes they could not afford. Then the bubble began its expansion. Rising interest rates and rising home prices propelled the market to new highs. Consumers leveraged ownership to heights never seen before. Like many banks, homeowners owed as much as 10 times their annual income. One small slip and the roof would cave in. Innovation was step 2. Wall Street invented the CDS and Congress passed the Commodities Futures Modernization Act of 2000, which deregulated the sale of CDS. Without government regulation, Wall Street rapidly expanded the derivatives market. Derivatives of derivatives, packaged and resold globally, led to a very fragile system. Soon Wall Street surpassed Fannie and Freddie as the primary buyer of mortgages. The tipping point was reached in August 2007, when a lender company in Irvine, California failed. Normally, the failure of a single small firm has little impact on the larger financial system. But this time was different. Why? The 2008 financial meltdown is a classic example of Perot's normal accidents. Charles Perot describes all kinds of catastrophic failures in his book, Normal Accidents, Living with High-Risk Technologies. The basic premise of normal accidents is as follows. First, there is nothing unusual about accidents. They happen all the time, and hence, accidents are normal. What is unusual is the size of an accident. In other words, we normally don't expect accidents to cause a lot of damage, and normally they do not. Rarely, however, the consequences of an accident are surprisingly high. The small accidents are overlooked, while the big accidents make us ask, why? Second, normal accidents start out small and infrequently grow into a major catastrophe. Big accidents are just like small accidents, only larger. Therefore, a normal accident occasionally turns ugly, and when it does, it is due to the snowballing of a series of small events. Once in a while, the snowball grows so big it results in a major catastrophe. Perot illustrates a number of catastrophic events and suggests that they are all made of the same stuff, a series of small incidents that spread and grow because of connections to one another. In other words, normal accidents happen all the time, but sometimes faults propagate along connections that magnify and expand the fault. In highly connected systems, a small fault can spread and magnify, becoming a large accident, natural disaster, or terrorist attack. In the case of the financial meltdown, the series of snowballing incidents were rising interest rates leading to a housing bubble, complicity of bond rating agencies, innovation in the derivative market, spread of derivatives throughout the world, failure of a small lender in Irvine, California. Each incident is insignificant by itself, but when connected to another, even a small incident gets magnified, and its consequence increases exponentially as it spreads. Here is how Perot's normal accidents theory applies to the financial network we established earlier. By August of 2007, the financial system had evolved into a highly connected network, as simplified here. Unbeknown to anyone, this network was in an unstable state because of the factors described on the previous slide. It had reached a tipping point called self-organized criticality. We study the theory of self-organized criticality later on. Even the slightest failure in this network had the potential to spread through the network, snowball into an even bigger event, and ultimately collapse the entire network. The collapse was triggered by a small incident, the failure of an insignificant lender in Irvine, California. This would normally be an isolated event, except for the fragility in the system and the connections binding the network together. Because of the highly connected nature of this network, the small event in Irvine, California, rippled through the network, triggering a chain of failures in firms that depended on lower-level firms. Of course, one failure should have little effect on other firms, but because of the house of cards built up over the 1990s and housing bubble of 2003-2006, all firms in the network were unable to accommodate much stress. They were unable to absorb even a small change in transaction flow, represented in our model by links. Here we see the domino effect propagating up the layers of the network, from lender to intermediary, to derivatives innovator, to foreign banks. All firms connected or linked to the lowest level are affected, and in some cases, forced into default. Failure at the lowest level of this network rippled up the network, level by level, taking out firms that depended on lower-level firms. Ultimately, the insignificant event in Irvine, California, magnified as dominoes fell throughout the network. The question we should ask at this point is, under what conditions can the failure of a few firms at the lowest level result in the collapse of the entire network? To answer this question, we turn to the complex adaptive system literature for an analog. The Amaral-Meyer Food Network, aptly described in Mark Buchanan's 2000 book, Ubiquity: Why Catastrophes Happen, is a perfect analog for the financial network. This network mimics the financial network of the previous discussion. It consists of nodes arranged in layers, each layer representing a tier in the financial network. Nodes represent slots or ecological niches where a firm can exist or not. A slot or node is occupied by a profitable firm, or it is unoccupied if the firm goes out of business. New firms mutate or enter the network at random, and extend links to occupied nodes at the level immediately below the new firm. We will study the effect of number of links on the consequences of a low-level firm failing. Firms go out of business whenever all links to them are removed. Firms at the lowest level randomly go out of business, just like the lender in Irvine, California. The simulation works by randomly removing nodes at the lowest level, removing their links, and propagating the failure up the network level by level. New firms are randomly inserted by mutation of existing firms, and placing them above, below, or on the same level as the existing firm. Here is what the simulated Amaral-Meyer network looks like in action. A black node signifies a firm in business. A white node signifies an empty niche or slot. Red blips indicate a mutation. A new firm is added to the network. Blue blips indicate an extinction. An existing firm goes out of business. Nodes at the lowest level are the only nodes allowed to go out of business. Links are removed when a node or firm goes out of business. Black nodes are turned into white nodes when all links to it are removed. White nodes are turned into black nodes by mutation. Note that the network grows, suffers many small corrections whereby a few black nodes are replaced by white nodes, and continues this process for long periods of time. Occasionally, the network reaches a state of criticality, whereby removal of a firm at the lowest level wipes out most or all of the black nodes. This simulates a collapse of the system. What causes the network to collapse? The network collapses when a failed firm at the lowest level is connected to all remaining black nodes. Recall that a black node is removed and replaced by a white node whenever all of its links from below are removed. Intuitively, the more links connecting firms to other firms, the more likely the collapse of the network, because a failed node is more likely to be connected to other nodes. We put this claim to the test by running simulations for 50,000 time steps and varying the number of links extended each time a new firm is added to the network. We hypothesize that increases in number of links corresponds with increases in number of corrections greater than 50% and the expected number of removed nodes. The results are shown in two graphs above. The graph on the left side of your screen plots the number of corrections that remove more than 50% of existing firms from the network over all 50,000 iterations. The graph on the right side plots the expected consequences in terms of average number of failed firms versus the number of links created each time a new firm is created. Clearly, the number of corrections greater than 50% and the expected consequences rises as the number of links rises. In other words, consequences rapidly rise as connectivity increases. This confirms our claim and suggests that networks tend to collapse when they are highly connected. More links means more consequences. Next, we ask, what can be done to mitigate inevitable collapse? The results shown here in the two graphs summarize three experiments. 1. Randomly select a firm at the lowest level and remove it. 2. Protect or pin the firm at the lowest level that has the most links, too big to fail. 3. Purposely remove the firm that has the most links, limit the size of firms. The most highly connected firm is called a hub. Random removal of firms leads to the highest consequences. In fact, consequences increase along an S-shaped curve that is bounded only by availability of firms. The pinned or protected strategy, whereby highly connected nodes are protected and allowed to continue to operate, reduces consequences only slightly. The strategy of attacking the hub as it forms has the greatest mitigating effect. In this strategy, consequences are reduced by as much as 5 times over the random selection strategy. This suggests the following. 1. Protecting hubs is not as effective as limiting the size of hubs. 2. Firms that are deemed too big to fail should be removed or split into less connected firms. 3. The most effective strategy is to limit the number of connections or links in the first place. The most effective strategy of the 3 studied here is to limit the connectivity of firms. Consequences increase with number of links, so limiting the number of links reduces consequences. In terms of the financial meltdown of 2008, it is better to limit connectivity than to prop up a failing firm. The number of corrections greater than 50% is reduced by 90%, and the expected consequences is reduced by 50% when using the hub limiting strategy. This result has policy implications that apply to financial systems as well as other networked systems accurately modeled by the Amaral-Meyer Network. In summary, the Amaral-Meyer model suggests changes in policy. The firms in a financial network are not too big to fail, but they may be too connected to fail. If we want to reduce consequences of so-called normal accidents, our policy should be to limit the number of connections to other firms. This lesson applies to other infrastructure systems. Many sectors are cross-sector interdependent and contain highly connected hubs. We can either protect them or eliminate them. It is preferable to eliminate them, but when this is impractical, we must protect them. Examples of other infrastructures with similar network structure are the power grid, the telecommunications network, many transportation systems, and some water treatment systems. The Amaral-Meyer simulation may apply to other sectors as well. This is discussed in subsequent modules. To find out more, read the following. Perot's book is the original disaster tome. It is still the final word on disasters. This module is yet another validation of Perot's theory of normal accidents. Buchanan's book gives clear explanations of complex adaptive systems theory and introduces the reader to the Amaral-Meyer Network, but in a different context. For a more in-depth treatment of complexity theory, read Melanie Mitchell's Complexity, a Guided Tour. Most books on complexity theory are mathematical essays, but Mitchell manages to explain just about everything in non-mathematical terms. The Age of the Unthinkable by Joshua Cooper Ramo provides an even broader perspective. He uses complexity theory and self-organized criticality to explain political and economic turmoil. Ramo claims we are in an age of the unthinkable because normal accidents are bound to happen, but we cannot predict when, where, or why. We can only prepare for them by anticipating the inevitable. A common thread through all of these is the simple observation that all catastrophes are simply everyday normal accidents or undesirable incidents, but a few turn out to be big. When a big disaster strikes, we are surprised, not by its occurrence, but by its magnitude. However, humans tend to overlook the small accidents while obsessing on the rare big ones.